What's up, guys? In this episode, we're going to talk about funds versus holding companies, the similarities, differences, why you'd want to do one or the other, and how they come into play. So let's get into it. This first part, just a second order review here. The common structure of a fund is you've got your general partnership over here. It manages the limited partnership, and money comes into the limited partnership. Investors come in, you go buy assets or real estate, or you trade, and that's a common fund. Let me make something clear. A fund is great for buying and selling something, okay? Like that's buy and sell. The reason being is because these investors over here, they are on a timeline. They don't just want to give you money forever and get their money back. Just let you manage their money till they die or till the end of the lifetime. Like, they want to make sure that they can take their money out and invest it elsewhere if you're not performing well, or landscape changes, whatever. So a fund works really well at the process of buying and selling. The common, cycle of a fund looks like this. You kind of start in year zero. Hedge funds, obviously go out in perpetuity or crypto. Venture, private equity, real estate, closed-ended, going to be like, 10 years, we'll call it on average. And there's kind of three phases. There's kind of the, acquisitions phase, then the value add, and then the dispositions phase. And that's just pretty common. Obviously venture, it's more, there's not as much on the value add side, but that's like the common life cycle of a fund. Now I get people coming to me and asking all the time saying, Lincoln, this asset right here, let's say is real estate or a company. What if I don't want to sell it? I want to keep it and I want to hold it in perpetuity, or I just want to cash flow from it forever. That's great. But that's probably not the best thing for these guys right here, these limited partners. They don't want to be exposed forever. Now, if you have royalty rights or something and they get their principal back plus some and then just get a check forever, that's fine. But usually people are saying, well, no, I want to buy my limited partners out and I just want to hold the asset forever. I mean, you can, and that's kind of where this concept of a holding company comes in. So it can be either an LLC or a corporation. You just want to talk to a legal advisor. The main reason why people do funds, like the general partnership, limited partnership structure, is this carried interest is a tax loophole. And, if you were just to do this same thing through a corporation, you're going to get taxed way more. And you're not subject to the same carried interest loophole. So, that's the main reason people do funds. But if you want to go out and just build this property or buy this property and cash flow from it forever, then you should probably just syndicate it, these one-off deals. And, because syndication, you can write the terms. It's just not as complicated because you have to adhere to, every LP's wants and needs. A holding company, you can say, hey, look, at the end of the life of the fund, when I'm going to sell, because I'm going to sell this asset and the money is going to go, back, through here and then come back to you guys and then also, pay out the GP as well. I'm going to say, look, I'm going to sell it over to this holding company over here. And that way I'm gonna, hold it and, cash flow from forever. Well, there's a couple things there. First up is this holding company probably doesn't wanna do that. That's probably not in the best interest of the holding company because you've already, added your value to this asset. It's already appreciated. You forced appreciation or not, either through forced or natural appreciation. So you may not really want to do that. It's not that great for the holding company. Additionally, it's not it just doesn't look good to the LPs. It just makes it look like, you are just wanting to, get the most gain here. So they're probably going to require that if in a structure like this, that you have an auditor come in and make sure that this asset is sold at fair market value. So basically what you would have sold it for had you just, sold it to somebody else, this company can come in and they're going to come in and audit it. So don't get me wrong, you can do that. But the second problem is this holding company has to have money to buy the asset, right? So when people invest in holding companies, either an LLC or corporation, they're structured differently. It's like investing into a private market deal. So they're going to come in and invest. You can have investors come in and buy shares, stock of your company, interests of the LLC. But here's some considerations. It's usually private. So these dollars come in. This is usually a private entity. So then these shares are very illiquid, right? So people don't want to invest in something that's illiquid. They want to get their money back. So it's kind of harder to attract dollars there. And it's it's very much a blind pool because people want to know what asset you're buying, right? And in holding companies, it's very usually opportunistic, and it's just like, I decide 100%, I decide when to sell, I decide everything, and you're now an owner in this company, and if they want to get out, their shares are harder to sell. It's a secondary market transaction, and it's just tough. Now, if it's public, it's usually a bit better. Like if it's a public entity, obviously they can sell their shares a lot easier. So a perfect example of this is Warren Buffett, right? A lot of people say Warren Buffett's the greatest investor of all time. Warren Buffett is not a hedge fund manager. He did not set up one of these. He basically set up a holding company. It was almost like a reverse merger / SPAC, because he acquired a shell corp. So he basically acquired one of these. And then he just started buying and trading shares, and you're regulated differently than if you are a fund. A fund has a lot more freedom. A holding company does not. So basically a fund can do whatever it wants, within regulation. A holding company has to report. They have to do a ton of, it's definitely more costly. The direct payment out isn't as good. Just because of the carried interest, the tax benefits aren't as good. Now, obviously Warren Buffett made it work. Like a holding company can be great. It's just a different route to go. It's definitely a lot easier if it's public. So and then obviously Warren he will acquire majority stakes in companies over time and get in and out of them. Some common ones is insurance. With Geico and, Delta, he really liked airline stocks. He's a value investor. He really liked common ones like Coke, and, he looks at, dividends and Kroger and, all these other ones that he'll buy majority stakes there's kind of a lot there. If you own more than 10% of outstanding shares, you're kind of regulated as an owner. A whole different conversation. But I hope that this video kind of shows you the differences of a fund. So a fund is buy and sell. A holding company is just way longer term, okay? Like this is, hey, if you invest in this holding company via buying shares, you're buying stock of the company. Because over here, this limited partnership owns the asset, right? Because that's the problem, is limited partners, they go and buy, like the manager is managing the limited partnership. The limited partnership has custody of the asset. And that's when managers are like, no, well, I want to own the asset over here. Well, you can't do that in a fund. If you want to do that, you need to have a holding company. So I hope you guys learned something in this video. Let me know if you have any questions. Hope you guys have a good one.